Ladies and gentlemen, good day and welcome to Hindware Home Innovation Limited Q1FY24 earnings call hosted by Monarch Networth Capital. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rahul Dani from Monarch Networth Capital. Thank you, and over to you, sir.
Yeah, thank you, Aman. Good afternoon, everyone. On behalf of Monarch Networth Capital, we are delighted to host the senior management of Hindware Home Innovation. We have with us today Mr. Salil Kapoor, CEO, Hindware Home Innovation Limited, Mr. Sudhanshu Pokhriyal, CEO, Bath Division, Mr. Rajesh Pajnu, CEO, Pipe Division, Mr. Sandeep Sikka, Group CFO, and Mr. Naveen Malik, CFO, Hindware Home Innovation, and CDR, the Investor Relations team. We will start the call with the opening remarks from the management, then we'll move to Q&A. Thank you, and over to you, sir.
Good afternoon, ladies and gentlemen, and welcome to Hindware Home Innovation Limited Q1 FY24 earnings call. Kindly note that some of the remarks or observations made during today's call might be forward-looking, such as financial projections or statements regarding the company plans, objectives, expectations, or intentions. The company does not have any obligation to revise these forward-looking statements to reflect any future events or developments. For a comprehensive disclaimer, please refer to slide number 2 of the presentation. At the outset, I am pleased to introduce and welcome Mr. Salil Kapoor, CEO, Hindware Home Innovation Limited. Salil brings with him over 30 years of diverse experience, primarily in the consumer durable field. His sector expertise and insightful perspective will play a vital role in shaping our strategic objectives. In his earlier assignment, he has led Orient Electric Appliances Division and held leadership position at LG Electronics, Samsung, Voltas, among others. Salil will be representing consumer and retail business in this investor call. Now, let me briefly touch upon our performance for the quarter, post which the business CEOs will discuss the key highlights of their respective businesses. Our quarter performance was largely impacted by a challenging external environment resulting from increasing inflationary concerns impacting demand of consumer discretionary goods. Against this backdrop, the company registered revenue for the quarter, which stood at rupees 634 crore. Despite lower top line though, our EBITDA and margin improved on a year-on-year basis to rupees 68 crore and 10% respectively. This is primarily the result of a better product mix and operating efficiencies, along with initiatives towards optimizing working capital management in alignment with our provided guidance. Our focus in the near term is to identify and adopt business strategies that will help us navigate the inflationary challenges. We continue to make steady progress towards building a pipeline whose backbone is innovation and customer centricity. Our long-term endeavor is to introduce a range of smart, connected products that integrate innovation and aesthetics, enriching our customers' lives and living spaces. We remain confident about the prospect of our businesses and its ability to drive growth. I would like to call Mr. Sudhanshu Pokhriyal to take you to the bath business. Over to you, Sudhanshu.
Thank you, Naveen. Good afternoon, everyone. In Q1 FY24, our revenues were flattish compared to the corresponding quarter last year. We delivered a revenue performance of 362 crores over last year Q1 of 364 crores. This is a degrowth of about minus 11% in QOQ terms, quarter-on-quarter terms, and is a CAGR, 4-year CAGR of 13% over Q1 of pre-COVID FY20. Our flat growth is largely because of the heavy base of last year Q1, where we had taken an extremely high price increase considering the input price situation there at that time. So additionally, the market demand has also been muted in Q1. Albeit with a lag, increased input and land prices along with higher interest rates with significantly increased EMIs has impacted the demand in the building material space. This is also visible in the results of many other listed companies which have declared their results. While the demand in the premium real estate is relatively okay, mid and affordable segment demand has seen larger impact, and this is expected to last for 1 or 2 more quarters. This is also visible in town tier level sales, where we see degrowth in smaller towns. Unpredictable rains and erratic overall weather situation has also impacted consumer demand, especially for renovation. While we are already seeing offshoots of improving demand situation in Q2, we expect the demand to revive from Q3 onwards. In Q1, we have managed to improve product mix of sales. This, along with lower input prices and a stringent focus on working capital management, enabled us to deliver a strong improvement in bottom line. We've seen a good improvement in our profitability and margins during the quarter. Our EBITDA reached rupees 61 crores, marking a 27% increase and translating to an EBITDA margin of 16.47%. Our EBITDA margins improved 360 basis points year-on-year and experienced a notable improvement sequentially with 140 basis points as well. This improvement is largely owing to our efforts toward increasing the share of high-margin products. We had also informed the market about our strategy of moving to produce larger, more premium sanitary ware products in-house, and I would like to inform the investors that we are on track for the same. The entire exercise will be completed by Q3 end. During the quarter, we reduced our working capital by 7 days over March 23, aligning with our 15-day commitment for the year. Moreover, we plan to direct our capital investment toward creating brand stores for market expansion and efficiency enhancement in existing manufacturing. These initiatives aim to elevate product ASPs and margins. For our bathware business, we have beaten the other listed entities in growth by a large margin and gained significant market share in the last 2 financial years. We are confident of continuing to gain our market share on the back of a well-crafted growth strategy that we've adopted. The first is to continue to launch innovative products across segments and categories. Secondly, we continue to build the brand Hindware. Thirdly, to consistently expand our distribution reach, as we believe there is significant opportunity in Tier 2, Tier 3 cities. Our fourth area of emphasis in strengthening premium and luxury category of products. All these efforts are underlined by our strong influencer programs for key stakeholders such as architects and plumbers, amongst others, and strong 360-degree integrated marketing campaigns for all our brands. We continue to retain our guidance of 1.25 to 1.5 times of the market growth rate for our revenue. We have given a guidance in 2021 and we've been achieving our guidance, and we believe we are on track in a mid to long term. I would now like to hand over the call to Mr. Rajesh Pajlu to take you all through plastic pipes and fittings business. Over to you, Rajesh.
Thank you, Sudhanshu. Good afternoon, everyone, and thank you for joining us for this earnings call. Trueflow, our brand for plastic pipes and fittings, aims to maintain its status as the fastest growing brand in its sector. In this quarter, the segment reported revenue of 156 crores, Q1FY24. The revenue was impacted primarily due to a sluggish demand scenario coupled with reduced raw material prices. EBITDA reached at 10.4 crores with margins at 6%. While our volumes experienced an increase of 13% year-on-year during the quarter, lower PVC resin prices pulled down the same in value terms. Our PVC products exhibited improved performance while CPVC sales saw a marginal dip, contributing around 40% in value terms as compared to 47% last year. In Q1FY24, we connected actively with plumbing consultants, plumbers, and organized multiple training sessions for our channel partners and influencers. We intend to maintain these efforts in subsequent quarters to reinforce our presence. Our commitment to expanding our distribution network remains steadfast, with our 280 active distributors and around 25,000 retailers currently in our network. Despite these challenges, we remain committed to our goal of expanding our market share, and we are actively making efforts towards price realization and incentives to drive volume growth. Our unwavering dedication to enhancing brand awareness also remains a top priority. as we aim to fortify our position. Our foray into PTMT faucets and other accessories provides customers with a comprehensive solution for all their plumbing needs. And our exclusive collaboration with Reliance Worldwide Corporation, we introduced TrueFlow Shark Bite, a revolutionary line of multi-layer composite and hold a European patent for push-to-connect joining system. In line with our accelerated growth strategy, we continue diversifying into new regions. Our Roorkee greenfield project is on track with operations expected to commence by Q3FY25. Our performance instills assurance that we are making good progress towards exceeding the sales target of rupees 1,000 crores before the projected FY25 guidelines. I would now like to hand over the call to Mr. Salil Kapoor to take you through consumer appliances and retail businesses. Over to you, Salil.
Thank you, Rajesh. Good afternoon, everyone, and thank you for joining us for our Q1FY24 earnings call. I'm excited to be a part of the Hindware Home Innovations team. I do believe the company has a lot of exciting opportunities, and we are in the process of charting a strong growth path. Our continuing endeavor will be towards consolidating and enhancing our portfolio with innovative and customer-centric offerings and supporting these initiatives with effective operations and supply chain and focused sales and marketing. Our quarterly performance is largely effective of the challenges prevailing in the sector at present. Consumer demand, particularly in small towns and rural areas, was impacted on the back of inflation concerns. Our kitchen division, though, demonstrated strength on the back of our technically superior product portfolio and our focused multi-channel distribution strategy comprising both online and offline and of exclusive brand shops. For this business, we have both gained market share and improved on the margin front. The demand for our cooling products, however, saw a decline due to a delayed monsoon. Increased inventories compelled market players to offer discounts in order to stimulate sales. As inflation begins to taper and the festive season commences, we expect the demand environment to strengthen. We will continue to leverage our core strength of innovation and introducing technically superior products. We have now submitted applications for over 33 patents and will continue to build on that. Our unified commerce approach will continue to drive performance across channels both online and offline. That concludes the opening remarks, and I would like to ask the moderator to open the floor for questions and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Udit Gajwala from Yes Securities. Please go ahead.
Yeah. Hi, team, and thank you for the opportunity. So firstly, on the bathware side, if you see, then you stated that the peers have not reported growth, but when we look at your closest listed peer, they have reported growth on YOY basis, but we have reported a flattish number. Is it because we are losing market share, or is it because the metro is slow versus they are concentrated?
Yeah, so that's a fair question, and what I would like to say is that for the last 2 consecutive financial years, we've beaten the closest competitor in FY22 by 40% over 20% their growth, and last year on 29% over 22% their growth. So for 24 months, we've been gaining share on them. This is the first quarter phenomenon. I give a number of quarter-on-quarter growth as well. The decline for the closest competitor has been 19% over the previous quarter versus our decline on quarter-on-quarter is minus 11%. So what it very clearly indicates is that we had a higher base in quarter 1 of last year. It's a technical point because last year we had a larger price increase which gave us some substantial gains in quarter 1 of FY23. And that's the key reason. I would really urge all the investors who look at market shares and trends on a slightly longer term basis, and in my view, reacting to on a quarter on quarter basis on market share terms is, I would say, something which can be avoided.
See, most of our guidance is, like we always add a caveat to our guidance whenever we give. We always say that don't measure us on a quarter-to-quarter basis. We have a strategy in place and we are walking our path. And if you see last 24 through whatever we are doing, so markets at all times are not under the business control, like markets. Some of the quarters do have, upsides and downsides. So that's the point which we are trying to reiterate here and what Sudhanshu is trying to communicate.
Fair, sir. And so secondly, when we say it is 1.25 to 1.5x of market growth, do you have any, like for pipes, we have a target of 1,000 crore. Is there any ballpark number that you all are internally targeting by 25 for the bathware division?
We have maintained that we would grow by 1.25 to 1.5 times the growth is because, and we maintain that and not give a percentage term or an absolute number because we peg ourselves to market growth. Now, as we see in this current quarter, the market growth has actually come down quite significantly. So, in my view, I think we should stick to the fact that we will beat the market by 1.25 to 1.5 times. I dare say the market, which was growing at 15% plus, in the previous 2 years, has cooled off, and I believe it will be in mid-single digits. So by that logic, we should be growing in teens. But I would still refrain from giving you an exact number.
Okay. And so coming to the pipe business, have we, the other peers have reported volume growth in the north of 14-15%. I understand that we are not a part of Jal Jeevan as much because we are more towards the plumbing end only. But on volume front, would you like to throw any guidance for 24 and what kind of EBITDA per kg are you expecting for full year?
See, we definitely are into the addressable market of plumbing and not the agricultural side. And since plumbing had a pressure and we still have grown by 12.5% of the volume, wherein the CPVC there is a decline. And our last year, our percentage of, which I already said in my opening remarks, percentage to sales was around 47%. This year it is just 50%. There's a pressure on plumbing. And we are looking forward that, and also the declining prices of PVC. We have increased our volume by 27% in PVC and declined around 12% in CPVC. But all said and done, we are hopeful that yes, lower side of double digit this year, complete year, will be having our EBITDA.
EBITDA margin, sir, is that?
Yeah.
Okay. And so just last question from my end. So we are seeing a falling prices in CPVC as well. Was there any element of inventory loss this quarter? And is that also a reason where the dealers are not stocking inventory because they are anticipating falling prices?
We didn't have any inventory loss as far as CPVC is concerned.
Okay. And anything on the PVC market?
PVC is definitely, there was a little, because since we are not now carrying huge inventories in this industry, last 1.5 years, people are not carrying inventory. So there is hardly any impact of, say, around approximately very less impact of inventory loss.
Okay. Thank you for answering, sir. I'll fall back in the queue.
Thank you. The next question is from the line of Harsh from Chris PMS. Please go ahead.
Hello, am I audible?
Yes.
Yes, you're audible. Please go ahead.
Wanted to understand how are we on our initiative for adding new dealers for pipe, and what is the current revenue per dealer and what is the dealer turnover which we are seeing? Is there any dealer who's leaving Hindware? Specifically for the pipes division.
Yeah, we operate with something. This business is on a super distributor model. So we operate at the moment with around 280 distributors. And we have increased the distributors to the tune of 30 to 35 distributors in the first quarter. But the growth is not there because of the pressure on the sales. But we have built more people than the last quarter.
Okay. And are we seeing the revenue? So the revenue per dealer is flat, and are we seeing any dealers leaving? or these are the net 35 dealers added?
Has come down. In fact, we have built 34 people more in this quarter, but the revenues have come down.
Okay.
There is a pressure on secondaries and stocking of the product.
Okay. Thank you. That was the only question.
Thank you. A reminder to our participants, please press star and 1 to ask a question. The next question is from the line of Nikhil Gara from Abacus AMC. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. So firstly, on the plastic pipes division, I just wanted a confirmation. You said the decline in CPVC was 1% and the growth in PVC was 27%, right?
Pardon? Yeah, the growth in volumes of PVC was around 27% and almost around the same degrowth in volumes in CPVC, which amounts to around 12.7% of volume growth, overall volume growth. Because you process more in PVC.
No, you mentioned CPVC decline is how much, sir? Sorry.
Almost around same decline, 27%.
Okay, because mathematically that would, I don't know whether it would work, because if we have...
You process, Nikhil, tonnage-wise you process more PVC.
Okay. Okay, I'll confirm that later. But just coming to the reason, because when you say that, the housing demand has been weak, but when we see the growth that we have seen in PVC, is it fair to assume that because PVC has become more affordable, we are seeing, the consumers switching more to PVC, and hence we are also seeing this sort of a decline in CPVC?
No, precisely not. To a certain extent, yes, but the growth in PVC as reported throughout the industry is because the Q1 has been too good for agricultural market.
Mm-hmm.
So PVC contributes to agricultural market also, but that is not in our addressable segment.
Mm-hmm.
So for the people who may report some growth in, because Q1 is almost for a plumbing sort of an market, it constitutes around 17 to 18% of the total revenue. That is Q1. But when it comes to these are two different segments. When it comes to the agricultural segment, it's almost around 26 to 27% of the whole year. So people who are more into agricultural segment have definitely done well in this Q1.
I am assuming that we are not selling any agri pipes. So basically for us, it really should not matter, right? Whether, how the agri demand pans out or does not, especially if our major channel is going to be through housing, right?
So we do manufacture agricultural pipes, but what happens is agricultural pipes these days are also used in the household applications. They are used in place of when it comes to a joining system. There is a pasting type of a joint. So people tend to use agricultural pipe than the SWR pipe, so which makes it little cheaper. The system gets cheaper. So people have used it, and I think we have sold in that segment. That's why our PVC growth is there.
So in that case, can you share, the agri versus housing mix for this particular quarter, and can you share it over year-over-year basis so we get a better understanding?
That's a very small component. I think, Nikhil, what Mr. Pajnu was trying to say is that when you see the results of various competitors, they are showing a PVC growth, and that PVC growth is primarily coming from agriculture segment rather than the plumbing segment. That's the point which Mr. Pajnu was trying to put forward.
Okay, sir. Fair enough. So just on the margins front for pipes, when we mentioned that we have not seen any major inventory loss, so excuse me, is it fair to assume that the margin impact that we are seeing is purely because of mix?
See, the margin impact is basically because we are the base is very small. Since we are a very small player, we are just growing. We are in our fifth year of operation. So all our operational costs are there. And the sale was there.
Sorry to interrupt, I understand that. I'm just trying to say, because fourth quarter as well, we have done, close to 10.5% sort of an EBITDA margin. And barring any inventory impact, because I assume that we would have still been closer to 8.5 or 9% sort of a levels. So I think the only reason could be mix, right?
No, it's like Q4 was a very high, it was the highest sale. So the industry does and we had also done. And Q1 we have just done 156 crores. So those operational things have only overheads which are fixed costs are there and then they have impacted this.
Okay, fair enough. And when you are guiding for a full year EBITDA margin of double digit, is what I heard, if I heard correctly. So from that perspective, you are expecting this mix that we are seeing in CPVC to improve, right, over the coming 9 months?
It should improve, especially in Q3 and Q4. So on a yearly basis, we can definitely aim to achieve double-digit EBITDA on lower side.
Got it, sir. And so secondly, just coming on the sanitary ware and faucets part of the business. Firstly, just on the margins front, can we give a breakdown between sanitary ware and faucets for this particular quarter versus year-over-year, please?
You want a ratio?
Yes, sir. Yes, ratio, please.
So faucets in this quarter is 35-36%.
And what would the same number be year-over-year, sir? Last year, same time?
Almost similar percentage.
Okay. So just on the overall EBITDA margin that we have seen, and we have seen an improvement even on a sequential basis. So is there any sort of a benefit in terms of any one-time benefit, or is it some more product mix benefit, if you can, sort of highlight it a bit in detail?
So, if you recall, Nikhil, we had a similar discussion while we were on a Q3 call or a Q2 call, actually. And then, at that particular time, there was a steep increase in the input prices. And we had communicated to the market that we are in the process of, enhancing our selling prices, so which has been done. But of late, what has happened is now, there is a moderation on the input prices, and gas prices are also coming down. So it's a pure impact of that, plus the product mix which is there. We have given a guidance for margin expansion, and we are holding on to that. I think whatever it is, we're given around 2%, which we said that we should do the expansion of margin in this particular next 12 to 18 months. So we are walking that path, and the reductions in the market, especially on the steep increases in the input prices, has normalized now. The markets are unstable. But I think what is impacting is the high inflationary rates, higher interest rates. The EMIs have for the respective consumer classes increased. So there has been some headwind on this business, on the building material business, on account of all these factors. We feel that it's a phenomenon. In I think Q3 will be more over when the festival season comes. There is always a certain reaction to the market, and then when the festival season comes in, the mindset of the people. They come into the spending mode, so it revives back. In the history, we have seen a number of quarters happening like this.
And just to add, I think it's not only about what is the faucet contribution or the sanitary contribution. It's within the sanitary ware and within the faucet that shifted to a more premium, and that's what I mentioned in my opening address. So within the sanitary ware and within the faucet ware has actually been better mix, for us. We've been able to procure better. Our input prices have come down. So this is that's where the margins are actually.
Yeah, I think one point which you would like to highlight is I think there are many people have seen our media sports which we have done with IPL. So I think we can talk about that also.
Sorry to interrupt you, sir. So your voice is not very clear.
Yeah, and in Q1 we also had a major event on a major sponsorship of IPL which we had done, which I'm sure most of the investors would have seen. So that also was focusing on the more premium products. So we continue to focus on premium products, and that's been one of our key strategies in terms of improving our margins.
So then, just on the just to close out the EBITDA margin part, so do we see this sort of margin that we are seeing run rate improving further because we are also going to add, higher margin products in house, or do you think this sort of a run rate sustains for FY24?
So I think this should sustain right now. Then, what we are trying to put forth is in Q1 there was a media spot, and IPL is an event which happens in Q1, so we spent time there also. So, but there are some, again, on the media spot, then Q2 is a little bit lean, but then Q3 again, because all the festive season comes in, and then the media spot will also start. So there's an opportunity always to spend the margin here, but we are taking an optimal call here, spending very judiciously on the marketing, supply chain, product. Everywhere there are a number of initiatives which are being done, and on the back of it, we are very confident that like whatever growth numbers we are talking on a medium to long term range, and also the margin expansion which is known, which the guidance we are giving, we should be able to do that.
Got it, sir. Just one last question from my side before I join back in the queue. I guess you mentioned that you are targeting a 50 days working capital commitment in the sanitary ware and faucet business. Did I hear it correctly?
15 days, not 15.
We said we would improve our working capital by 15 days in this year, and we've already done that by 7 days in Q1, is what I mentioned in my opening remarks.
So that basically goes to 90 days, 90 to 100 days.
Yes. I mean,
like we were at 112 days for our past business, now we are at 105 days.
And we've basically been below, 100 days, 97, 98 days for the year.
Sir, is it also that we have tightened our working capital cycle a wee bit, also impacting our growth by any chance?
No, our DSOs are very similar to last year on our receivables. It's our inventory which is actually, we've tried to control.
Okay. Got it. So I have few more questions. I'll join back in the queue.
You can continue asking, I think we can take it. So one we can finish it.
Okay, great, sir. So coming just, on the consumer durables part of the business, and I understand that, air cooler sales might have been lost because this being one of the major seasons. Just from the perspective of how we see this business, especially now in 24 as well as in 25, what kind of a growth can we target in this business, and is it going to be from the existing products, or do you think that some new products need to be introduced to basically scale this business up so that our fixed costs also get sort of used up and we get the operating leverage benefits?
So if you look at, we already have 3 strong pillars of growth. The products that we have already invested in past, both on the product portfolio front as well as the distribution front. The first one being sports kitchen segment, chimneys and other associated products around it. The second one being water heaters, where we have now a JV and our own production facility, which will improve not only the product per se, also on the margin front. And third, of course, the air coolers, where we have a very strong digital presence, and we have both a large chunk of the online sales. Now, we will go further deep into these categories and build on that going forward. There are other segments also which are available. We have quite a few of them. We might want to reevaluate those and look at certain categories like air purifiers and heat convectors and others, which are highly seasonal and the sell-out window is too brief. So those we might want to reevaluate, but we'll certainly go deep and build further on the 3 large growth pillars that we have invested in already.
Understood. So, any guidance for 24-25 that you would want to give at this point of time, so that we'll get some clarity how to evaluate?
I think I'll take another quarter before I can give some guidance, and I will also get some more time to look at the opportunities that we can unlock. So let's wait for 1 or 2 quarters before we can actually come down on exactly the numbers and on the projections.
Sure, sir. And sir, just one last part from my end. If you could highlight our debt reduction plans, I think we were mentioning somewhere around 100 crores for FY24. And if you can also give some numbers for 25 as well, how do we see the net debt numbers going? Because we are still seeing an increase in the net debt tables if we see from quarter-on-quarter basis.
So, Nikhil, we stated that with the given capex of odd ranging 140 to 150 crores in this financial year, we should be able to clear off our debt by around 100 crores. Next year, we we'll have some spending again on the pipe plant, which is under set up at Roorkee. So that plant cost is 180 crores. This year we'll spend about 60-70 crores on the project, and rest will be spent next year. So we'll take another figure of another 100 crores repayment next year. But we are very gung-ho on our businesses, like pipe business. So we see that there's a good potential in this business. That's why we want to do this project much faster now, actually.
So is it fair to assume that our net debt still would be in the range of 650 to 700 odd crores by FY25 as well?
How much is the figure you have on 23?
23 was, I think, somewhere around 720 crores, if I'm not wrong.
So 720 minus 100 and another minus 100.
But we are also doing the capex, so that was the reason I was asking.
But we are earning profits also.
So then basically we are just have to say that 200 crores deduction would happen in the net debt.
That's the plan actually, as on date.
Got it, sir. Fair enough. Thank you and all the best. Thank you.
Thank you. The next question is from the line of Yash from Steinberg. Please go ahead.
Thanks for the opportunity. I have one broad question, one more specific question. The broad question, since Hindware is obviously operating in the whole real estate space, the real estate market actually is doing quite well, at least as per my channel checks. Why is it that our revenue growth has been sluggish in an environment where, let's say, the industry growth has been pretty strong?
Yeah, so as I mentioned in my opening address, the real estate market is basically growing very well, relatively well in the premium segment. However, mid and affordable segments are basically under stress, and if you want, I can quote some numbers. The affordable part of the segment actually grew by 21% in the last 6 months, as per reported numbers, while mid segment, I don't have exact numbers for that. Affordable is defined as a segment because government decides the selling price of the affordable segment. It's a very well-defined segment. So that new launches grew by about 21%. So what we're saying is the real estate market is actually seeing action only in the premium segment in the metros, but not at an overall level. So that's what our position is.
Understood. And one question on the margin side, where let's say after the Q4 results, there was a guidance of about low teens margin for the full year. I want to understand, let's say it's been about a year since we have taken the manufacturing in-house, where initially the margins didn't reflect because raw material prices were high. In this quarter, we've seen the raw material prices compress quite significantly with almost a 4 percentage points improvement quarter on quarter. I'm just surprised, where is the balance margin going? And in terms of, ideally the thought process was that on the year before, let's say there was before the manufacturing was in, we were at the 8-9% margin range. The thought process was that when manufacturing would come in, we will see about a 400 bps improvement in that margin. It just seems that has not played out in the current quarter despite the improvement in raw material prices.
Basically, if you see how much is the number you have for bathware business of Q4 FY23?
Q4 FY23, I have 15.3% EBITDA margin.
Sorry, my apologies. FY22.
FY22, I have about 11.5%.
Now it's 16.7.
Okay, correct.
So the mathematics which we are trying to do is basically what you have to see here is we gave a guidance, whatever, like if you see till 31st March 2022, we were buying from our other group company on a cost plus basis, And even periods we were buying at an EBIT margin markup for our basket business around 4.5% EBIT margin level. So whatever the cost was being incurred there, 4.5% at EBIT level cost was being passed on. Now, since there is no factory there, there is no cost other than the rentals which are there for the factory. Because the 2 parcels of land and building which we did not do because of the very high cycle rates and high stamp duty tax. So that entire margin flow is already happening into the business. So your apprehension where the margins are going is margins can't go anywhere. There is no other factory now other than Hindware.
Understood. No. So I'm saying that it could also be because of negative operating, like adverse operating leverage. The idea was to understand that we've seen 5 quarters of the transition play out. So
5 quarters have not been the natural quarters, because if you just benchmark the input prices over the last 24 months, you will have all those answers with you. The gas price from 18 rupees to 60 rupees right now at 40 bucks, 45 rupees. Input zinc prices, brass prices, everything moved up. The CPVC prices again, it had a big swing on either side. So the point I think which I have been trying to reiterate is that we bought those factories. Now it's a consolidated operation, a focused company. So there are no other substantial related party transactions as it was happening before. Whatever the factory margins were, they are now being a part of Hindware only. It's not that we have started producing inefficiently now. It's still producing very efficiently. So whatever the margins are there, there's a combo of, it's not an apple-to-apple comparison right now. That's very difficult to maintain.
So would it be fair, sir, to say that this margin, let's say suppression of margins at some level is partly because of the fact that 2-3 businesses are operating at suboptimal margins, which is the pipes and consumer business at this point, and even the retail business?
So pipes will not say it's a suboptimal, because to be very frank, we just don't make any commitment on a guidance on a quarter, because if you see consistently, like when we did our results last year we have been disclosing how much is our inventory loss. So if you add the inventory losses, which the entire industry suffered actually, it has been done very transparently that PVC resin prices moved from 160 rupees to almost 75-80 rupees. So whatever the inventory loss anybody is holding in this industry, the entire pass on is a pass on, to the end consumers. So if you add, you will see that there is a consistency in the margin which is happening. We are making a consistent gross margin in the business. We are making, but this again a mathematical feat in a sense. Like sometimes the rate goes up, sometimes some other factors are playing. But what you have to see from the perspective of the gross margin, we have been able to maintain our gross margins in our business. In fact, we have been expanding that over the last few years.
Understood. And so given that given that all the segments are operating at different numbers, and as you also mentioned, what's happening is the multiple moving parts are not resulting into, let's say, the current reported margin being similar to what it was earlier. I just thought it would be possible for you, sir, to kind of give, let's say, on a steady state basis, assuming normalization, what would be the kind of segmental margins that we should expect? And if that's possible, so that would be very helpful.
I think we can look at it, but I don't confirm right now, because then we have to create a segmental margin correlation over last so many years. And market has been volatile. We had COVID events in between. So we'll try to do that. It's a good question. We'll try to work on it.
Understood. And sir, one question, the 16.7% margin that you mentioned, is that after allocation of corporate costs? Or that's before allocation of corporate costs, right?
Yes.
So sir, sorry to kind of just double click on this, but essentially historically we've made in the previous avatar, which is with the HSIL, and for 5, 6, 7 years, we actually did more than 20% margins or near about 20% EBITDA margins in this segment. So do we see our margins for Hindware segment, which is basically X pipes and fittings, going to 20% plus?
I think if you see in the history, we have been doing ranging 90 to 21% margins on sanitary ware. But predominantly during that time, we were primarily the sanitary ware, business. Our faucet businesses during that time was ranging 200, 250 crores. But the sort of margins, percentage margins which we have in sanitary ware is still high. But what happens is, as the faucet business is also growing, it gets averaged out. To be very clear, we don't make 20% plus EBITDA margin on faucets. So it's a mix of the bucket. So as the businesses and the growth on the faucet size in the market size is much bigger. So as the growth of the faucets increases, absolute EBITDA will increase, but the percentage margins will decrease because the input factor in sanitary ware is a clay, but in input factor in faucets is brass. So much costly material. So you have a numerator and a denominator effect coming here.
Understood. And sir, with your permission, I'd just like to ask one more question. On the retail business, so what is the thought process here? Because it doesn't fit perfectly within our scheme of things. So just thought maybe I could ask you about that.
We have spoken about this business. As on date, the status remains the same. We are looking at various alternatives. What should we do with this business? Definitely, I understand what your question is. I can only sum up saying, we are evaluating various options of this business right now.
Thank you. Yash, may I request you to join the queue for any follow-ups, as there are several participants waiting for their turn. Also, before we take the next question, we'd like to remind our participants to limit their question to 2 per participant. If time permits, you may join the queue for any follow-ups. Thank you. The next question is from the line of Abhishek Ghosh from DSP. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. I have 3 questions. If you, in your bathware business update, your net working capital days has come down by about 7, as Anshu also mentioned in the call, but your net borrowing has increased. So is it on account of higher capex, or what is it that related to?
Abhishek, Naveen this side. Hindware has given the dividend to the Hindware Home Innovation. So that is why this around 29 crore got added. So that was on last week of the June.
Sorry, could you repeat that again, sir?
So basically, when you compare the borrowing as of 31st March 2023 versus 30th June, so there was a dividend of about 29-30 crores which has been paid by Hindware to the parent company. As a result of which, one time the borrowing increases as such.
But so this should not impact our consolidated level debt from net debt from that perspective.
Yes, technically so, because the money will move from bottom to the top.
So on a bathware segment basis, the debt has gone up, but on a consolidated level, the debt should have come down because the working capital has also come down and plus. So how should we look at it in that light?
Yeah. Mathematically, yes.
So on a consolidated level, has the net debt remained stable? Q on Q?
It has come down from 113 crores for the consumer business to 95 crores. So it has reduced here by around 18 crores. Yes.
Sorry, your voice is not very clear, sir.
For the consumer business, if you see the slide 25 for our presentation, so it has reduced from 113 crores to 95 crores.
Okay. And the same thing is with, if you look at the pipe division as well, Rajesh, we had seen a good working capital reduction in 4Q. Again, the net working capital days has increased. Any thoughts on the same? And what is the stable net working capital days that one should probably look at?
Sorry, Abhishek, we request you to please remain connected. It seems we have lost the line for the management.
Sure.
Okay, ladies and gentlemen, we have the management line reconnected. Sir, over to you. Abhishek, may I request you to repeat your question, please?
Thanks. So in the plastic pipe division, we have seen a net working capital seeing an increase on a Q-on-Q basis from about 62 to 92 days. So what's the stable net working capital days that one should work with in the pipes part of the business?
Number of days? Net working capital number of days should be ranging around 80 to 90, 75 to 80 to 90.
Sir, should range between 80 and 90, is it?
Yeah.
So last quarter was an aberration.
Yes, because it's very difficult. When the sales are down, everything goes for a spin.
Fair. Okay. And just in terms of your retail business, we have seen about a 3.5 crores kind of an EBIT loss in the current quarter. Any thoughts, because that's a segment that was barely breaking even. So any thoughts in terms of going forward, while you've spoken about briefly in terms of evaluating the business, but in terms of losses, is there any exercise being done to kind of control the losses there?
If you see, I talk about the strength of the businesses. This business used to do 100 crores odd business while we were in the retail model. Very good brand, Evoke brand. The recall of people on the Evoke brand is very high because we had a pan-India presence. Now the business models over the last 4-5 years have changed. A lot of searches are happening on online portals. And again, the competition there is also, being increased every day. Like we had dedicated online furniture businesses. They are going from online to offline. Then there are other Amazons and others who are also selling furniture. So in the interim, we shut down around 3 years back. We shut down our retail business and we moved on to the primarily franchise business, plus the online business which is there. So we are evaluating what we can do with this business. We understand this is not the core business on which we should attack, but we have to understand and evaluate various options before we take a decision. I think another 3 to 6 months we may do something with it.
Okay, sir. Thank you so much. Wish you all the best.
Thank you.
Thank you. Before we take the next participants, we'd like to remind the participant, in order to ensure that the management is able to address questions from all participants, please limit your question to one per participant. The next question is from the line of Darshil Jhaveri from Crown Capital. Please go ahead.
Hello. Good evening, sir, and thank you so much for taking my question. So, from what I understand, so maybe our major segment, some pressure in the next 1-2 quarters, but we might see strength coming back. So, overall, on a broad basis, in maybe FY25, could we achieve better growth? And when can we see our consolidated margins, maybe going to 11-12%? And I also just wanted to ask about the level of tax that we had this quarter was a bit higher. So, could we help some reconciliation in that?
So your voice was not clear to us. I think the question which you had was...
Hello. Sorry. Am I audible, sir?
You are audible, but your voice, I think you are holding your microphone too near to your mouth.
Sorry, sir. Is this better, sir?
Now it is much better. So I think what I could understand is, one question is on the margin expansion and second is on the tax. Am I right?
Yeah, correct, sir.
So I'll request Sudhanshu to talk broadly and on the margins, what the number of initiatives which we are doing internally on the product mix, putting material aside. And on the tax side, I think, I don't know whether you read the note to the accounts 2B and 2A. So there was a dividend, as I told, being paid by Hindware to the parent company. And as a part of the consolidation, what happens is the dividend gets knocked off because it's a relationship between the parent and the subsidiary. But the tax on the dividend is provided. So what happens is on a standalone basis, you will find the rationality of the tax rate. But on the consolidated basis, you will not see that rationality because dividend gets knocked off amongst the parent and the subsidiary. In terms of margin, Sudhanshu, we can talk about a few initiatives which we can talk.
Yeah. So margin, I think, I think I mentioned in the previous question as well. One of the key initiatives which we're doing is, which we talked in the last investor call as well, is that we are planning to reduce our import dependence and increase domestic procurement of both our sanitary and largely sanitary ware. And we are well on course for this transition. There is a transition that is happening in our manufacturing plant, which I mentioned in my opening remarks, is going to get concluded by end of Q3. We've also developed extremely strong suppliers in domestic markets. We believe from a number of about 16-17% of import dependence on FY23, FY25 should be a mid or low single digit number in terms of percentage contribution. And that will be a massive impact on our profitability. Can't really give you a number here, but these are all initiatives will add on to the committed numbers in terms of margin expansion. Additionally, like I said, we are focusing a lot on premium products, dependence on Odisha fans and basically WCs is now converting into one pieces and wall mounts, and similarly, for example, in faucets to premium diverter-based faucet products. So that's something which is expanding definitely will give us margin expansion. We are also, working a lot in terms of, reducing our costs. There are lots of design to value initiatives which are happening within the organization in terms of lightweighting of products, in terms of looking at re-engineering the products to make sure that the products are basically satisfying the needs of the consumer and are not over-designed. And then that really adds a lot of value in terms of expansion of margins. All these things, which is really helping us in terms of increasing our margin at an overall level to be delivered.
Thank you, Mr. Javeri. Request you to join the queue for any follow-ups. The next question is from the line of Abhishek Ghosh from DS.